On the morning of March 28, 2007, Circuit City Chief Executive Philip Schoonover approved an internal memo from the Richmond, Virginia headquarters that would be read aloud in more than 600 stores across the United States by the end of the day. The memo instructed store managers to identify every hourly associate paid more than 51 cents above the local market wage. Those employees were to be called into back offices one by one and told their positions were terminated effective immediately. They could reapply for their old jobs in 10 weeks at the new lower pay rate. There were 3,400 of them. They were the highest paid hourly workers Circuit City had. They were also, almost without exception, the most experienced, the most productive, and the ones customers actually asked for by name when they came in to buy a television or a laptop. By close of business on March 28, they were gone. Schoonover called the program a wage management initiative. Analysts on the call the following morning were told it would save Circuit City approximately $110 million a year. Wall Street responded well. The stock closed up more than 2%. Inside the stores, something else happened. Fired associates went to work the next day for Best Buy, for H.H. Gregg, for regional chains. Customers walked into Circuit City that spring and could not find anyone who knew the difference between a plasma screen and an LCD. Same-store sales, already weakening, began to fall faster than any comparable retailer in the country. Circuit City had, at that moment, 20 months left as an operating company. To understand the scale of what Schoonover eliminated in a single afternoon, it helps to understand what Circuit City had been. In 2000, Circuit City was the second largest consumer electronics retailer in the United States, behind only Best Buy, and it was closing the gap fast. The company operated 616 superstores and generated $12.96 billion in annual revenue. It employed roughly 60,000 people. Its market capitalization crossed $10 billion. It had been profitable every year for more than 2 decades, and its stock had been one of the best-performing equities on the New York Stock Exchange from 1982 through the mid-1990s, returning more than 8,000% over that stretch. That last number matters. In 2001, business researcher Jim Collins published a book called Good to Great, the result of a 5-year Stanford study identifying the 11 American companies that had made the leap from good performance to sustained, decade-long, market-beating excellence. Circuit City was one of the 11. Collins used it, alongside Walgreens, Wells Fargo, and Kimberly-Clark, as a textbook case of disciplined management, cultural rigor, and operational excellence. The book sold more than 4 million copies. For years afterward, Circuit City was taught in business schools as a model of how a retailer builds a durable competitive advantage. The advantage was specific. Circuit City had built the modern American consumer electronics store. The first superstore opened in Richmond in 1979, engineered by founder Samuel Wurtzel and his son Alan, around a simple insight. Consumer electronics were becoming complicated enough that customers needed help, and the retailer that trained its staff to provide that help would win the category. The stores were laid out with a wide central aisle, product demonstrations at every station, and a commissioned sales force expected to know the specifications of every product on the floor. Those commissioned salespeople were the engine. A veteran Circuit City associate in 2000 could earn $50,000 to $70,000 a year selling televisions, cameras, and computers, and many of them had been with the company for a decade or more. They knew the product lines. They knew the return policies. They knew regular customers by name. When a family walked in to spend $3,000 on their first flat-panel television, they were spending it with someone who had sold hundreds of them. The company backed those associates with infrastructure that was, at the time, best in class. Circuit City ran one of the earliest and most sophisticated point-of-sale and inventory systems in American retail, built in-house through the 1980s. It ran its own credit card operation through a subsidiary called First North American National Bank, which by 2000 was generating hundreds of millions of dollars in additional profit annually. It ran an entire second business, CarMax, which it had launched in 1993 as a used car superstore concept and spun off in 2002 at a valuation that would eventually exceed Circuit City itself many times over. Culturally, the brand was everywhere. Circuit City sponsored NASCAR. It advertised in every Sunday newspaper insert in America. Its red and gray logo was as recognizable to a suburban family in 1998 as McDonald's or Target. When a household in the United States wanted a camcorder or a stereo, or, later, a DVD player, Circuit City was one of two places they considered. The other was Best Buy, and through most of the 1990s, Circuit City was ahead. This was the company Philip Schoonover inherited. Not a struggling regional chain, not a broken business model. A good-to-great case study with 60,000 employees, 600 stores, and a 50-year track record of building the American electronics retail category from nothing. That is what makes the March 28, 2007 memo the pivot moment it is. Schoonover did not fire 3,400 people from a company that was failing. He fired them from a company that had, only a few years earlier, been considered one of the 11 best-managed corporations in the United States. The company that ended on March 28, 2007, began 58 years earlier in a rented storefront on West Broad Street in Richmond, Virginia. Samuel S. Wurtzel was a 39-year-old Jewish immigrant son from New York who had come south during the war and stayed. In 1949, he opened a small shop selling televisions to a market that barely existed yet. Richmond had received its first television broadcast that same year, from a single station operating out of a converted radio studio. Wurtzel named the store Ward's Company, the letter standing for his wife, his two sons, and himself, Wurtzel, Alan, Ruth, David, Samuel. The insight that would define the company came not from Samuel, but from his elder son Alan, who joined the business full-time in 1966 with a law degree from Yale and a doctorate from NYU. Alan Wurtzel spent his first years walking the floors of Ward's small chain of Richmond area stores and reaching a conclusion that ran directly against the retail conventional wisdom of the time. Discount department stores were expanding rapidly across America, led by Kmart and Woolco, and they were killing specialty retailers by underpricing them on the same national brand appliances and electronics. Every consultant and industry analyst told Ward's to consolidate, shrink, and defend a niche. Alan Wurtzel decided the opposite. He decided electronics were about to become the most complicated products a middle-class family would ever buy, and the retailer that helped them buy correctly would take the entire category. The first true expression of that idea opened in Richmond in 1979. Wurtzel called it the Circuit City Superstore. It occupied 30,000 square feet, roughly 10 times the size of a standard electronics store of the era, and it stocked more than 2,000 different products across televisions, stereos, appliances, cameras, and the first generation of home video equipment. Every major product on the floor had a working demonstration model. Every category had its own trained specialist. Customers who walked in did not browse a wall of boxes. They walked a central corridor lined with product theaters, and a commissioned associate met them at each one. The commission sales structure was the operational core of the model. A Circuit City associate earned a small base wage and a percentage of every sale, tiered by product category and margin. A salesperson who moved a high-margin extended warranty on a big-screen television that afternoon took home a check that reflected it that pay period. The system rewarded product knowledge, closing skill, and long tenure. It produced a workforce that stayed. In an industry where store associates typically turned over every 8 to 12 months, veteran Circuit City salespeople routinely stayed 5, 10, 15 years. Alan Wurtzel took over as chief executive in 1972 and would run the company through its formative expansion. The superstore concept scaled fast. Circuit City opened its first stores outside Virginia in the early 1980s, moved into Texas and California by 1985, and reached 100 stores nationally by the end of that decade. Revenue crossed $1 billion in 1987. It reached $2 billion by 1990. The company was adding roughly 50 stores a year, and it was doing so profitably without the leverage or the promotional discounting that its competitors relied on. Wurtzel retired as chief executive in 1986 and handed the company to Richard Sharp, an electrical engineer who had joined Circuit City in 1982 and had personally built much of the point-of-sale and inventory infrastructure that made the superstore model work at scale. Under Sharp, Circuit City became one of the most sophisticated retail technology operations in the United States. Every store was linked to a central inventory system in Richmond that tracked stock, adjusted pricing, and forecast demand at a granularity that most retailers would not match for another decade. Sharp also drove the two most important non-electronics decisions in the company's history. In 1989, he launched First North American National Bank, an in-house credit card operation that would eventually generate more than $500 million a year in additional profit. In 1993, he approved a small internal project to test whether the superstore concept could be applied to used cars. That project became CarMax. By 1997, Circuit City operated 493 stores in 145 markets, generated $7.7 billion in revenue, and was valued by Wall Street as one of the strongest retail franchises in America. The stock had returned more than 8,000% since 1982. Jim Collins and his research team began their 5-year study of it that same year, alongside their study of Walgreens, Nucor, and Wells Fargo, looking for the specific management disciplines that produced sustained excellence. The trap that would end Circuit City was, at that exact moment, being built. And it was being built out of the same commission sales model that had made the company great. The trap was this: Circuit City's competitive advantage was the most expensive workforce in American electronics retail, and its largest competitor was building a store designed specifically to eliminate the need for that workforce. To see how the trap closed, you have to look at Best Buy. Best Buy had been founded in Minnesota in 1966 as a small stereo shop called Sound of Music. It was a fraction of Circuit City's size through most of the 1980s. Then in 1989, Best Buy chief executive Richard Schulze introduced a new store format he called Concept 2, and it inverted every assumption Circuit City's model was built on. A Concept 2 Best Buy did not use commissioned salespeople. The store paid its associates a flat hourly wage. Product was moved off the wall and onto the sales floor in open aisles that customers could walk without being approached. Signage did the selling. Boxes were stacked so customers could grab them and take them to a central checkout. The store looked and functioned like a warehouse. The economics were transformative. A Best Buy Concept 2 store carried roughly 1/3 the payroll cost per square foot of a comparable Circuit City superstore. Its associates required weeks of training, not months. Its inventory turned faster because the floor layout encouraged self-selection of higher volume, lower margin products, televisions, cameras, and increasingly, personal computers. The strategic problem this created for Circuit City was structural. Circuit City could match Best Buy's prices. It could not match Best Buy's cost structure. Every dollar Best Buy took out of payroll went into lower shelf prices, wider assortment, and store expansion. Best Buy grew from 40 stores in 1989 to more than 300 by 1996. It passed Circuit City in total revenue in 1996 and never looked back. Circuit City's leadership understood the threat. They understood it in extraordinary detail. Richard Sharp discussed the Best Buy cost gap in earnings calls throughout the mid-1990s. The company commissioned repeated internal studies of the Concept 2 model. The consulting firm McKinsey advised Circuit City on multiple occasions. Everyone inside the company knew that the commissioned sales force was, on a per-transaction basis, more expensive than the competitor's alternative. But the commissioned sales force was also the thing customers came to Circuit City for. It was the entire brand promise. It was what made the extended warranty attach rates the highest in the industry. It was what made the average ticket size 30% higher than Best Buy's. It was, per the Jim Collins case study still being written at the time, the operational engine of the entire good-to-great story. So Circuit City did what a good-to-great company was supposed to do. It doubled down on what had worked. Sharp and his successor W. Allen McCullough, who took over as chief executive in 2000, expanded the store base, upgraded the technology infrastructure, and preserved the commissioned model. They believed, correctly, that the model produced better customer experience per dollar spent. They believed, incorrectly, that better customer experience would continue to matter more than shelf price in a category that was rapidly commoditizing. Because this is the part the leadership missed. The products Circuit City sold were changing. In 1985, a color television was a complicated, high-margin purchase that a family made once every 7 years, and the salesperson genuinely mattered. In 1998, A DVD player was a $50 impulse purchase that a customer could specify from a consumer reports table before walking in the store. By 2001, the flagship products on a Circuit City floor were personal computers whose specifications were increasingly standardized and whose margins were collapsing. As margins collapsed, the commission per sale collapsed with them. Veteran salespeople who had earned $60,000 a year in 1998 were earning $45,000 in 2002. Turnover, historically Circuit City's greatest cultural asset, began to climb. The infrastructure that supported the commission model, the training, the systems, the store layout, remained expensive whether or not it was producing the same premium. Circuit City's response was a series of half measures. In 2000, the company decided to exit the major appliance business entirely, on the theory that appliances required too much floor space for their margin. It stopped selling refrigerators and washing machines in July 2000, ceding roughly $1.4 billion of annual revenue overnight. Sears and Home Depot absorbed it. The plan was to reinvest the freed-up floor space into higher-margin electronics. In practice, the exit removed a category that had brought recurring customer traffic into stores and disrupted long-standing vendor relationships. Same-store sales fell that year and did not fully recover. In 2003, McCullough approved the elimination of the commissioned sales model itself. The February 2003 restructuring converted the entire hourly workforce to flat wages, on the argument that this would bring Circuit City's cost structure closer to Best Buy's. Circuit City eliminated 3,900 commissioned positions and paid roughly $90 million in severance to do it. What it did not do was change the store format, the product mix, or the fundamental customer expectation that Circuit City was where you went for help. The stores kept their commissioned-era layout. The associates stopped earning commissions. The best of them left within 18 months for jobs that still paid on performance. By 2005, Circuit City had, in effect, the worst of both structures. It carried the store format and infrastructure cost of a full-service specialty retailer. It carried the workforce quality of a discount box store. It carried the brand promise of the first without the operational reality to deliver it. Same-store sales fell in 2005. They fell again in 2006. Wall Street began to write the company off. And onto that Wall Street, in early 2006, walked Philip Schoonover. Philip Schoonover was, on paper, exactly the executive Circuit City's board thought it needed. He was 51 years old when he took over as chief executive in March 2006. He had spent 17 years at Sony Electronics in senior merchandising roles. He had then spent 6 years at Best Buy, rising to executive vice president and running the customer segmentation strategy that Best Buy chief executive Brad Anderson credited with the company's mid-2000s outperformance. Schoonover had been recruited to Circuit City in October 2004 as chief merchandising officer specifically to bring the Best Buy operational playbook inside a company that had spent a decade losing to it. 18 months later, the board promoted him to chief executive. The board's mandate was explicit. Close the cost gap with Best Buy. Restore same-store sales growth, do it fast. Schoonover moved fast. In his first 12 months, he closed 70 underperforming stores, exited several unprofitable markets, and announced plans to remodel roughly 130 remaining locations in a new format, the company called The City. Then, on March 28, 2007, he announced the decision he would be remembered for. The mechanics of the wage management initiative were precise. Circuit City's human resources team had built a compensation database matching every hourly associate to a market wage benchmark for the associate's specific role, tenure, and location. The company ran a query identifying every associate paid more than 51 cents above that benchmark. The query returned 3,400 names. Store managers were given a script and a Wednesday. Schoonover's public reasoning was cost. The eliminated positions would save Circuit City roughly $110 million in the coming fiscal year. He framed it in the March 28 press release as a strategic move to allow the company to hire additional associates at lower rates and grow total store staffing. The fired employees were told they could reapply for their old jobs at the reduced pay after a 10-week waiting period. Very few of them did. What happened in the following weeks was documented in real time by trade publications, local newspapers, and the associates themselves. Best Buy district managers began contacting Circuit City stores directly, offering interviews to the fired staff. Regional chains like H.H. Gregg and Ultimate Electronics did the same. Within 60 days, the majority of the terminated associates had been hired by direct competitors, taking with them decades of accumulated product knowledge, customer relationships, and vendor familiarity. Inside Circuit City stores that spring and summer, the effect was immediate. The remaining workforce skewed younger, newer, and less trained. Attach rates on high-margin extended warranties, historically, Circuit City's most profitable line item, fell sharply. Average transaction size began to drop. Same-store sales, which had been declining at low single-digit rates, worsened. The financial results arrived in the June 2007 earnings report, covering Schoonover's first full quarter after the firings. Same-store sales fell 5.6% in Circuit City's domestic segment. Gross margin contracted. The company reported an operating loss. Wall Street analysts began to model what had actually happened. The $100 million in payroll savings had been overwhelmed several times over by the collapse in transaction quality. The failure was not that Schoonover misjudged the savings. He got the savings. The failure was that he treated the commissioned sales workforce and its replacement by trained and tenured hourly veterans as a payroll line rather than a productive asset. The associates who had been earning 51 cents above market were, in aggregate, selling substantially more than that per hour of their time. Removing them removed the margin they generated. The math had been visible in Circuit City's own point-of-sale data since the company started tracking it in the 1980s. It was decided against anyway. The board, briefed on the results, kept Schoonover in place. His compensation for fiscal 2007, disclosed in the following year's proxy statement, was $7.4 million in total pay. The 3,400 fired associates had earned, on average, roughly $11 an hour. The Wage Management Initiative also did something that could not be captured in a quarterly report. It broke the internal covenant between Circuit City and the people who worked its floors. For 58 years, the company had positioned itself as the retailer that rewarded product knowledge and long tenure. The March 28 memo said, in effect, that the company would no longer do that. Everyone still working in a Circuit City store in April 2007 understood the message. The best of the remaining associates began to leave voluntarily throughout the second half of the year. Turnover, historically one of Circuit City's cultural moats, rose to industry standard levels. By the end of 2007, Circuit City had lost more than a decade of accumulated selling capability in 9 months. The stores looked the same. The shelves were stocked. The signage was intact. What was gone was the reason customers had walked past 3 other retailers to shop there. You would think this would have been the moment the board demanded a course correction. It was not. By early 2008, Circuit City's cash position was deteriorating faster than the operating losses alone suggested. The Wage Management Initiative had cut payroll but had also broken same-store sales. Vendors, watching the numbers, began to tighten credit terms. American Express, Circuit City's largest trade credit provider, reduced the company's terms from 60 days to 45, then to 30. Suppliers who had shipped televisions and computers on 90-day terms for 2 decades began to demand cash on delivery. Every day of shortened terms pulled tens of millions of dollars out of the company's working capital. Schoonover's response was to shrink further. In the first quarter of 2008, Circuit City closed an additional 155 domestic stores, roughly 1/5 of the base. It sold off the Canadian subsidiary Intertan, which operated more than 700 stores under the Radio Shack Canada banner, to a Bermuda holding company for $285 million in cash. It suspended the dividend. It drew down its revolving credit facility. On to that situation. In February 2008, walked Waddles Capital Management, a small activist fund run by an investor named Mark Waddles. Waddles had built and sold the video rental chain Hollywood Entertainment to Movie Gallery in 2005. He acquired 6.5% of Circuit City stock and began publicly demanding board seats, arguing that the company needed either new leadership or a sale. The sale offer arrived on April 14, 2008. It came from Blockbuster. Blockbuster's chief executive at the time was Jim Keyes, who had taken over in 2007 with a mandate to diversify the video rental chain into a broader retail concept before streaming permanently destroyed the store rental business. Keyes offered to buy Circuit City for between $6 and $8 per share in cash, valuing the deal at more than $1 billion. Circuit City's stock at the time was trading at roughly $4. The blockbuster offer represented an immediate premium of 50 to 100%. The Circuit City board, chaired by James Marcum, took nearly a month to respond. On May 12, 2008, the board rejected the offer as inadequate and refused to open its books for due diligence. Blockbuster's own financial advisor, Carl Icahn, publicly withdrew support for the deal in July, citing the deteriorating credit markets. The offer was formally rescinded on July 1, 2008. Circuit City stock, which had briefly rallied on the takeover speculation, fell back below $3 by midsummer and continued down from there. The failure to accept the blockbuster offer was, in retrospect, the last commercial exit Circuit City would ever be offered. Every alternative after that summer was a wind down. Behind the scenes, the operating business was collapsing on a schedule set by the Christmas season. Circuit City, like all consumer electronics retailers, generated a disproportionate share of its annual profits in the November-December holiday quarter. The company's entire 2008 financial plan depended on a strong Q4. To fund the inventory buildup for that quarter, Circuit City needed vendors to ship on credit through August, September, and October. They would not. Through the summer of 2008, more than a dozen major suppliers, including Samsung, Sony, and Hewlett-Packard, either cut terms further or demanded cash up front. Trade credit insurance, the policy that suppliers used to backstop their receivables from a struggling retailer, became unavailable to Circuit City by early fall. Without the insurance, no supplier would extend terms. Without terms, Circuit City could not stock its stores for Christmas. By late September, the inventory gaps in Circuit City stores were visible to any customer walking in. Empty shelves. Missing product lines. Delayed shipments of the flagship holiday televisions. Comparable stores at Best Buy, running the same negotiations with the same vendors from a position of financial health, were fully stocked. On November 10, 2008, Circuit City filed for Chapter 11 bankruptcy protection in Richmond. The filing disclosed $3.4 billion in assets and $2.32 billion in liabilities. It also disclosed that Philip Schoonover had resigned as chief executive 2 months earlier on September 22 and had been replaced by James Marcum, the chairman. The bankruptcy filing was intended as a reorganization. Circuit City's advisors believed the company could survive a debtor-in-possession financing package, close another 155 stores in Chapter 11, and emerge as a smaller domestic chain in early 2009. The holiday season made that impossible. Christmas 2008 delivered same-store sales down 44% year-over-year across the remaining Circuit City stores. It was the worst holiday quarter any national American retailer had ever posted. The empty shelves, the lost associates, and the collapsed brand promise had all arrived at the same register at the same time. On January 16, 2009, Circuit City's board and its creditors concluded that no reorganization plan was viable. The company announced the immediate liquidation of all 567 remaining domestic stores. It was the largest specialty retail liquidation in United States history to that date. The Superstore that had opened in Richmond in 1979 closed for the last time that spring. The liquidation itself ran from January 17 through March 8, 2009. Great American Group, Hilco Merchant Resources, Gordon Brothers, and Tiger Capital, the 4 largest liquidation firms in the country, jointly acquired the right to run the going-out-of-business sales for $285 million. They fired the remaining 34,000 Circuit City employees. Then they hired many of them back at reduced hourly rates to work the closing sales through February. Discounts began at 10% and ended by early March at 90% off. Fixtures, shelving, and store signage were sold in the final week. Best Buy's Richard Schulze, watching from Minnesota, told analysts that Best Buy's stores had gained roughly 1 full point of market share in the weeks after the Circuit City announcement. Amazon, tracking online electronic search traffic, reported the largest single jump in category demand it had recorded to that point. H. Gregg, and Fry's picked up regional share where their footprints overlapped with the closed Circuit City stores. The intellectual property was sold off in pieces. Systemax, a Long Island catalog retailer, paid $14 million in May 2009 for the Circuit City brand name, its website domain, and its customer database. Systemax operated CircuitCity.com as an online-only electronics retailer for the next 3 years. It shut the site down in December 2012, citing insufficient traffic. The credit card operation had already been sold. Bank of America acquired First North American National Bank in 2004 for $1.3 billion, well before the Wage Management Initiative, in a transaction that had temporarily masked the operating decline. The proceeds were used for share buybacks. Bank of America absorbed the portfolio into its consumer credit business and retired the Circuit City co-branded card in 2011. CarMax, the used car retailer Circuit City had launched in 1993 and spun off in 2002, continued to grow. By 2015, it operated more than 150 stores nationwide. By 2024, it had passed $30 billion in annual revenue and a market capitalization of roughly $12 billion. The company Circuit City had incubated inside itself and then given up was now worth more than Circuit City had ever been. The legal proceedings extended for years. Circuit City's bankruptcy estate pursued clawback litigation against former executives and vendors through 2013. Philip Schoonover was not personally sued. He surfaced in 2010 as chief executive of a small technology consulting firm, then took a series of board and advisory roles in private companies. He never ran a public company again. The Blockbuster offer, rejected in May 2008, took on a specific afterlife. Blockbuster itself filed for bankruptcy in September 2010, unable to compete with Netflix's streaming service. Its chief executive, Jim Keyes, who had proposed the Circuit City acquisition as a diversification strategy, resigned in April 2011. In interviews afterward, Keyes maintained that the merger, had it happened, would have created a combined physical retailer strong enough to survive. There is no way to test that claim. Both companies died independently within 2 years of the offer being rejected. The Jim Collins book that had celebrated Circuit City continued to sell. In a 2009 follow-up titled How the Mighty Fall, Collins used Circuit City as one of his primary case studies of a good-to-great company that had undone itself. He identified 5 stages of decline. Circuit City, in his analysis, had moved through all 5 between 2000 and 2009. The specific stage he associated with the Wage Management Initiative was Stage 3, Denial of Risk and Peril. By early 2010, the last physical trace of Circuit City in most American cities was the empty big box footprint of a closed superstore. Some were leased to Best Buy for competitive site defense. Some became Ross Dress for Less locations, Dollar Trees, or church spaces. In Richmond, the corporate headquarters building on West Broad Street was sold to a real estate developer and converted to office space. The people who had been fired on March 28, 2007, most of them continued careers in electronics retail somewhere else. A meaningful number of them retired from Best Buy. Today, Circuit City exists as a licensed brand name owned by a small Miami-based holding company that has attempted and abandoned multiple relaunches since 2016. It operates no stores. It employs, across all of its licensing activities, fewer than a dozen people. At its peak in 2000, Circuit City employed 60,000. The red logo still appears occasionally on third-party electronics accessories sold through Amazon. The stores are gone. The commissioned associates who built the category are gone. The superstore concept that Alan Wurtzel drew up in Richmond in 1979 was absorbed, refined, and now belongs to Best Buy. This is not a story about a company that failed to see the threat. Circuit City understood the Best Buy cost structure in detail, discussed it in earnings calls for a decade, and commissioned repeated internal studies of its own vulnerability. This is a story about what happens when a company treats its most productive people as a payroll line and mistakes the cost of expertise for the price of it. The associates fired on March 28, 2007 were not overpaid. They were the last people inside Circuit City still capable of delivering the brand promise the entire store had been built to sell. Removing them saved $110 million a year and destroyed the business that generated $12 billion. The math was visible in the company's own point-of-sale data. It was decided against anyway. A company can survive losing a category. It can survive losing a competitor. It cannot survive the moment its leadership stops understanding what the company is actually selling.